All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Wednesday, everybody. Today is March 5th, 2025. And that you guys might be looking at the title this morning and saying, WTF, what is going on here? Is the U.S. engineering a recession? What does that even mean? And maybe it should be. Why would you say that? All right. I see a lot of things happening. There is a great disturbance in the force, if you will, since I got my man Darth over the corner here. There is a upending of the global world order that is happening in the economies right now. The United States is going one way and Europe is going the other way. And it really does look like the U.S. is engineering a recession. Now, guys, we're gonna dabble it a little bit. We're gonna accidentally tread into political waters here. This is not meant to be political. This is meant to be economic and financial. Let me just say, on Monday, if you read the comments, everybody was like, oh, Jack is a MAGA Republican. Jack's going ultra right. And then if you read the comments yesterday, I was a bleeding heart liberal. So I'm going to take that as positive feedback. If the extremes are both yelling at me 24 hours apart, maybe I'm doing something right. So I said during the election or shortly after election day that there was no winner. All right. You obviously had one side lost the election, but the consolation prize was now the other guy is going to be in charge when the recession hits, and the recession will hit. We've been playing this game of the floor is price discovery for years. Fiscal deficits, easy monetary policy has created this bubble that should have burst a long time ago, but it hasn't yet for whatever reason. And then on top of that, I've been wondering, what does President Trump want more? He's going to have to pick one. His trade war or his stock market bubble? Which one does he really want? He can't have both. And, well, it really looks like he's choosing his trade war right now. I mean, I think that's pretty clear based on the last couple of days. Now, there's some wishy-washy language from Lutnick, the Secretary of Commerce, who's saying, hey, maybe we're going to meet Canada and Mexico in the middle. Okay, maybe it works geographically. Maybe it'll work economically too. But at the same time, he's pushing so hard on tariffs. And the one thing that really tells me he's going for his trade war more so than his stock market bubble is the fact that he's pushing for tariffs on semiconductors. Even last night, he was calling for getting rid of the CHIPS Act. All right. The CHIPS Act was the carrot that was supposed to bring semiconductors back to the United States. Instead, he's going with tariffs on chips, which is the stick that is going to bring semiconductors back to the United States. It's debatable whether either option would work, but that's the path that he's going. And of course, a 25% tariff on semiconductors would absolutely be like the sledgehammer that pops the AI bubble. It wouldn't be a pin. I mean, it would obliterate that bubble right away. They're spending so much money on these data centers and these chips right now. If all of a sudden just 25% goes to the government, increasing the cost of that, forget it. That CapEx at big tech is going to evaporate overnight. So the question is, why? Why would I say maybe the U.S. should be doing this? Why do I think this is actually a good idea? All right, now here's the point. All right, Main Street, United States, has been in a recession since 2022. For 9 out of 10 people in this economy, life has gotten harder, more expensive, wages have been stagnant, our standard of living has gone down. That is true for 9 out of 10 people in this country. And now that the election is behind us, even the mainstream press is finally admitting that. Welcome back to journalism, now that we're not pretending it's the best economy ever and that freaking pruny, decrepit, walking corpse was somehow cogent or sharp as a tack. Now that that's all behind us, we're actually admitting the way the world finally is. Great. That's good. So now that we can admit 9 out of 10 people have not done well in this best economy ever, then how do we fix that? Well, we've got stagnant wages, high cost of living, but asset prices at all-time highs because we're still playing this game of the floor's price discovery. We can't let commercial real estate come down because it might blow up some fund. So we can't let banks fail when we can print money and bail out Silicon Valley like we did with SIVB and Signature Bank. What else do we have? The AI bubble, which is just obscenely high valuations, all being propped up by easy money and round-tripping revenue. This stuff has contributed to this massive wealth disparity in America. And the wealth disparity in the last 5 or 6 years It was already very wide to begin with, and it has just blown out. So what we really need is an asset recession. We need asset prices to come down. We need a deflationary asset recession. We're already in an economic recession, and maybe not a textbook, again, because the 10% are doing so well. It looks like GDP is growing because GDP is growing. It's just growing for 10% of the population and not everybody else. So we need things like houses and stocks to be more affordable. And if you look at some of the language that is in the press today, they're saying things like, is the Trump put dead? Is the Trump administration trying to engineer a recession? Honestly, I think the answer to both of those questions is yes, because we're already in a recession. We just need the official definition to do so. And politically, if you're in the Trump administration, you need that to happen sooner rather than later. Because if you think about the politics of it, if the recession hits at the beginning of next year, that's a totally different story than if the recession hits at the beginning of this year, shortly after taking office, because politically he can just still say, oh, I'll just blame Biden. It has nothing to do with my tariffs or my government layoffs. When in actuality, the truth is both caused the recession. All right. Yes, Trump's tariffs and his government layoffs are going to subtract from GDP dramatically. They're going to push us into an official recession. But that official recession actually began years ago, and runaway fiscal policy and easy money just masked it. Both can be true at the same time. So that's why this funky headline this morning is the U.S. engineering a recession. Yes. And should they? Yes. Meanwhile, in Europe, they are going crazy in the other direction. All right. Europe has been in a fiscal crisis for the last few years because they're spending so much money on their green energy plans and all this other stuff and their social programs. And at the same time, European industry has been in collapse. Their energy policy is just run by imbecilic children. And I do mean that literally. And now, well, they've got a problem ever since the big blowout in the White House last week. You know, the reason I was a MAGA Republican on Monday. But ever since that blow up in the White House, in the Oval Office, there's been a lot of talk about all of a sudden we need this big surge in defense spending in Europe. European defense stocks blew up on Monday. Well, now look at what's going on in some of the European economies. We've got borrowing costs are spiking. We've got the euro is surging against the dollar. The DXY is breaking down right now. What else do we have? Look, they're going to inflate. Again, that's what they're going to have to do. Right now, we're seeing higher borrowing costs and higher demand for euros. What's going to happen? The European economy can't survive under those circumstances. And so what's going to end up happening is the European Central Bank and the various central banks in Europe, they're going to end up lowering rates and printing money. Now, how do you say Burr in Deutsch? I don't know, the Deutsche money printing Blatten. I don't know how you say it, but that is where Europe is heading here. They're going in the opposite direction of where Trump appears to be taking the U.S. economy. Europe is going to lower rates and they're going to print money. Right now, at least it looks like the United States is heading for a deflationary recession. Now, we may end up in the same place. The Fed may end up lowering rates and bringing back QE. I mean, they've done it every other time. Call me optimistic. I hope they don't do it this time around. But for right now, Europe is just going bonkers with the spending. They're doing the opposite of what the U.S. is. And by the way, something I forgot to mention on the U.S. rant, President Trump is talking about selling hundreds of buildings owned by the federal government, canceling thousands of leases for office space by the federal government. That price discovery in commercial real estate, it may be getting here after all. Look, the two economies going in opposite directions. Which one is right? I don't know. But guys, it's going to be messy. When you have this big of an upending of the global order, you're talking about economic brain surgery. And let's be honest, the people that are going to be performing this economic brain surgery are clumsy. They are not brain surgeons. I think we can all agree that these are not brain surgeons. Certainly Congress is not brain surgeons. And therefore, as they're doing this brain surgery with a sledgehammer, they're almost certainly going to cause a lot of damage, which means it could be messy. And that's why the stock market sold off so much yesterday. Although, as usual, the dip buyers showed up at lunchtime. We're going to look at some of the long-term charts and show you exactly where they showed up. That was no accident. But in the meantime, why don't we shrink my big melon of a head and let's see what's going on in the markets this morning. And if you please, hit that like button and that subscribe button for the YouTube algorithm so you can come back and have your coffee with the melon heads, because we do this every day. Right now, the S&P is just modestly negative, down 2 points or 0.04% in the black. But check out yesterday. In the red, not in the black. Check out yesterday. These are daily candles on the S&P 500, and look at where the S&P stopped yesterday. Should we zoom in a little bit? Almost right on the 200-day moving average. You see where that wick touches the red line there? That is when the dip buyers showed up at lunchtime yesterday. So we had a technical bounce off the 200-day moving average, as you would expect. I think we're going to challenge that level again. We'll see if it holds. If we zoom out a little bit, guys, we have not seen the 200-day moving average in the S&P 500 since November of, when is this? November of 2023 was the last time we got down that low. Even on that August 5th panic, we never got to the 200-day moving average. So the market is at an inflection point here. The Dow, meanwhile, is down 38 points or 0.09% lower this morning. Now, if we look at the long-term chart of the Dow, the daily candles, we are nowhere near the 200-day moving average. That could mean that the Dow has a lot further to fall before we hit that technical bounce. Looking over at the NASDAQ, we are up by 29 points or 0.15%. So stocks are kind of like right on the cusp here, some positive, some negative. It's a pretty flat day at the moment. We'll see what happens when the bell rings. But looking at the NASDAQ, this chart is a little more alarming because check out the 200-day moving average on the NASDAQ. We actually closed below that on Monday for the first time since November of 2023. And we closed below it again yesterday, even though that's a pretty impressive reversal that the NASDAQ made yesterday. The NASDAQ actually closed positive after starting the day down big time. So, it was a good reversal, but we're in the process of a technical breakdown in the NASDAQ. Again, even on August 5th, we did not close below the 200-day moving average. We opened below it, but we quickly rose. That was the day they took away the sell button. And if you zoom out on this chart, we haven't been here since November of 2023, or is that October? That was October, since Halloween, pretty much, of 2023 was the last time we were below the 200-day moving average for the NASDAQ. So, guys, winds are shifting in this stock market bubble. You can see it. Meanwhile, the dollar continues to weaken. 104.71. We got a 104 handle on the Dixie this morning. That's down 84 basis points. Now, the main input to this is the euro. We'll get to these charts in a minute, show you what's going on in Europe, but this is absolutely the runaway spending in Europe is what's causing this dollar to fall this morning. And then looking over at the bond market, we got yields are pretty flat today here in the U.S., even though they're spiking in Europe. The 30-year Treasury, 4.512. That's up by a half a point. I'm sorry, down by a half a point. The 10-year, 4.206, also down a half a point. The 2-year, 3.910, down by 4.5 points. The 2-year has been falling rapidly these last couple of days. And the 1 month is at 4.325. That's actually up a fraction of a point. Looking over at the commodities board, we've got spot gold a little bit lower this morning, $2,902 for spot gold. That's off by about $16 or 0.5%. Spot silver, meanwhile, is clinging to gains here at $32.04. It's still up by about a nickel or 0.18% higher. I like the shiny. Copper, meanwhile, 4.75 for copper futures. That's up about 4.3%, a little bit higher here. Probably tariff talk driving that one. Platinum is up 0.25%. Palladium is down by about 0.8%. And WTI crude continuing its slide down another $1.59 or 2.3% lower, with April WTI futures at 66.68 now. That is the OPEC increasing production plus the worries about a U.S. recession, all sending oil lower. I think oil is probably heading back to the 50s, if not the 40s, over the next few months. And looking at Bitcoin, a pretty shocking reversal in Bitcoin yesterday. Yet another one. The volatility in Bitcoin continues here. We're up this morning. $89,670 is priced on Coinbase. Look at the guys. Just wow. Look at some of these candles over the last week here, breaking down below the 200-day moving average. Big reversals. 1, 2, 3, 4 big intraday swings. Volatility is the name of the game, which means the traders are either getting wiped out or making a ton of money on these swings, probably a little bit of both here. But Bitcoin obviously remains a big question mark here. Questions about this strategic reserve. Is it going to happen? Won't it happen? I don't know. Only time will tell. All right, let's talk about some of these stories here and some of the shifting narrative. And, what's leaning me towards this? Why would we be doing an intentional recession here? This one in Market Watch. Is the White House trying to engineer a recession? This Wall Street pro explains the vision. Traders are starting to price in the possibility that the U.S. economy might fall into a recession. And one Wall Street veteran says that might actually be the Trump administration's plan. Charlie McElligott, a strategist at Nomura, dubbed Wall Street's most wired analyst by the Financial Times for his manic missives, focused on the options market, laid out that the argument in a note to clients. He said Republican President Donald Trump and his administration need an engineered recession to cause a growth slowdown and disinflation that will translate into Fed rate cuts and a meaningfully weaker U.S. dollar for the next phase of his economic agenda. And that paragraph is loaded with accurate statements here. It really does. And you might be sitting here looking at this title saying, why would Trump want a recession on purpose? Because everything Trump is trying to do requires a recession. He wants disinflation. Well, the easiest way to get disinflation, or dare I say a deflation, is a recession. If asset prices are continuously going up, it's hard to slow down inflation because sooner or later that translates into higher consumer prices. So absolutely, he needs that growth to slow down. He also needs a weaker U.S. dollar. If he wants to bring manufacturing back to the United States, you need a weaker dollar for that to happen, because a weaker dollar gives your manufacturers an advantage in global trade. And of course, he wants lower interest rates, and you can't have lower interest rates if you have high inflation. And so they need that inflation to come down first in order to bring the interest rates down with it. So yeah, if you look at what Trump's economic agenda is, what his stated goals are, you need a recession to get there. And then you got this one in Barron's this morning. The Trump put is dead. Tariffs were the fatal blow. And this is my answer to that question, or the answer to my question. What does the Donald want more, his bubble or his trade war? He's picking the trade war so far. The Trump put is done. The stock market has erased all of its meteoric gains since Election Day. Hopes for deregulation, tax cuts, and other fiscal stimulus from President Trump have been replaced by fears that his tariffs on Canada, Mexico, and China will ignite a full-blown trade war. I don't know about that will ignite. I'm pretty sure we are in a full-blown trade war right now. I don't think that's such a leap of the imagination. That outcome would most certainly hurt consumers and corporate profits and revive the economic threat of inflation. That's why Wall Street is suddenly worried again. Instead of excited about Republicans controlling the White House and Congress, there is no sign of the so-called Trump put, the expectation that he will do what he can to keep the stock market happy. And President Trump is definitely not doing what he can to keep the stock market happy right now. He's actually doing the opposite. And then we've got this one. This is another thing that's going to be a very recessionary story. The Trump administration releases a list of hundreds of federal buildings targeted for potential sale. Remember, guys, we still have this commercial real estate bubble that's been going on in the background. That hasn't gone away. We've just been playing extend and pretend. The floor is price discovery. Well, here we go. The Trump administration on Tuesday published a list of more than 440 federal properties it has identified to close or sell, including the FBI headquarters and the main Department of Justice building, after deeming them not core to government operations. And it's not just selling the buildings here. He's also talking about a big change to leases. You got to scroll way down here. But last month, the GSA regional managers received a message from the agency's Washington headquarters ordering them to begin terminating leases on all of the roughly 7,500 federal offices nationwide. And that word all really stuck out at me. Terminate leases on all 7,500 federal offices. So are they closing every leased federal office in the country, or are they just terminating all the leases and then they want to renegotiate them and bring them back by exception? I don't really know. It's kind of like the you're all fired and then, you can come apply for your job back. That kind of setup. That's a very Elon Musk kind of thing to do. So maybe that's what they're planning here. But either way, hundreds of buildings going up for sale, thousands of leases getting canceled. That's a lot of commercial real estate supply, a lot of office space hitting the market, and a market that is already stressed by a lack of liquidity and shrinking demand. Even though work from home is largely going away now, that demand still has not recovered to pre-pandemic levels. And another recessionary data point we got this morning, the ADP private payrolls came out, and it was a big miss low. Private businesses in the U.S. added 77,000 workers to their payrolls in February of 2025. That's the smallest increase in 7 months compared to an upwardly revised 186,000 in January and well below forecasts of 140,000. So almost half or nearly half of what was expected here. Now, the upward revision to January, it was only 3,000 revised higher, so that's just noise there. Trade, transportation, healthcare, education, and information showed job losses. That's a pretty widespread decline in private employment there. Policy uncertainty and a slowdown in consumer spending might have led to layoffs or a slowdown in hiring last month. Our data, combined with other recent indicators, suggests a hiring hesitancy among employers as they assess the economic climate ahead. Look, I'm sure tariffs is playing a role here. Policy uncertainty, it's having an effect on hiring. And I would just add, guys, this is private payrolls. So this doesn't, at least not directly, include government job losses and the people who have been laid off at the federal government. This may include private sector government contractors, people like that, or, like the guy who runs the hot dog stand outside the DOJ building, right? His job might be going away. So it's possible the government cuts are driving some of this here, but this number does not include the tens of thousands, possibly hundreds of thousands of government jobs that are going away. So we got some weak labor data. And again, we got that big non-farm payrolls coming on Friday. That's going to be an important data point. Now, check out this chart. We talked a lot about the U.S. Look at what's going on in Europe. This is USD EUR, the number of euros it takes to make $1. And look at what has happened. Here is Friday. Let me zoom in a little bit. Here's Friday. Here is the, as I said on Monday, the comedian and the reality show LARPing as Statesman. All right. That's when that meeting blew up in the Oval Office. And then look at what the euro has done every day since then. And remember, this chart heading lower, that is the euro strengthening versus the dollar. The dollar has gotten materially weaker this week, and the euro has gotten a hell of a lot stronger. So what's going on here? Well, there is a huge new demand for euros because after that blow up at the meeting, it was obvious if this war in the Ukraine is going to continue, it's going to be Europe who continues it, not the United States, right? Forget your opinion on the whole thing. Let's just face the reality of what it means. It means Europe is going to have to spend more money on their own militaries. They can no longer rely on the United States to do everything for them. And so they're going to have to spend more euros. Well, they don't really have more euros. And well, when the supply stays fixed and the demand goes up, the value goes higher. And we're seeing the euro go higher. And we're also seeing interest rates all throughout Europe are heading higher. Look at this chart here. This is from the great Martis on X. The German 10-year up 8.5%. The French 10-year up 4.4%, 14 basis points higher. The UK 10-year 1.2% higher, 5 basis points. Spain's 10-year 13 basis points higher, 4.3%. Italy 12 points higher, 3.6%. It is getting more expensive to borrow all throughout Europe. You got a currency surging, a stronger euro. You have higher interest rates. Europe's economy can't sustain this. Ultimately, the central banks are going to end up printing their way out of this problem here. And you can see it here. This is the German 10-year Bund. This is the biggest bond in the European market. And you can see right down here is Friday, and the yield, the interest rate on the 10-year Bund has just gone vertical. And it's going to keep going vertical until the central banks ease. All right. We talked about Europe. We talked about the U.S. We also got some earnings happen this week. Foot Locker results show the sneaker industry and Nike still have more pain ahead. Here's another story about that stressed consumer, the cautious discretionary spending going on. Foot Locker said Wednesday it expects another year of deep discounts in the sneaker industry as its largest brand partner, Nike, continues its reset and relies on markdowns to clear through stale inventory. Why is that inventory stale? Because it's not selling because people don't have money for overpriced sneakers. And so it's been a rough year for Nike and for Foot Locker. That stock is actually up here, believe it or not. I guess there was a lot of negativity priced in. It was down 2.9% yesterday. It's clawing back some of that, up 1.8% this morning, trading at $17.69 or about 32 cents higher. Meanwhile, CrowdStrike, the fallout from that big hack last year, it is getting worse. CrowdStrike sees more costs ahead in the aftermath of last summer's outage. Shares of CrowdStrike Holdings tumbled more than 9% in after-hours trading Tuesday after the cybersecurity company's guidance disappointed investors. The company also provided new disclosures about its recovery from the July 19th service outage that rippled across the global technology landscape. For the latest quarter, CrowdStrike reported $21 million in costs relating to the flawed software update. That brought the fiscal year's total to $60.1 million. And CrowdStrike expects $73 million more of outage-related costs in this fiscal first quarter, including incremental sales compensation and additional costs of $43 million associated with the customer commitment programs it initiated to retain customers after the outage. The company offered discounts to help keep customers. Everyone loves a comeback story, and that's exactly what we've started experiencing in Q4 as we've closed out the year, said CEO George Kurtz. Yeah, the emperor doesn't share your optimistic appraisal of the situation here. You got to love this positive speak. I mean, they have to do it, right? The CEO is the chief stock salesman for the company. But when things are so awful, they're just like, everybody loves a comeback story. Okay, yeah, try to bad news bears your way out of just how awful your company is performing right now. The stock is down 7.2% ahead of the opening bell, $361.01. That's down by more than $29 this morning. Rough day for CrowdStrike. Although year-to-date, it's actually up 14%. So really, they're just giving back gains from earlier this year. Another one we got, this one a little more along the lines of the Foot Locker story. Abercrombie & Fitch forecasts a cautious 3 to 5% sales growth in 2025. Now, Abercrombie & Fitch has actually had a pretty good year. They've seen some pretty good growth when a lot of apparel retailers have been doing terribly. But it looks like that growth is slowing here. Abercrombie & Fitch stock was down 6.5% in pre-market trading on Tuesday after the retailer said it expects its 2025 sales to increase by 3 to 5%, below analysts' expectations for 5.5%. Fourth quarter revenue rose 9%, just under $1.59 billion, ahead of the analyst estimate of $1.57. So you can see when you've got fourth quarter revenue growth rose 9%, and now they're saying 3 to 5% sales growth in the next quarter, a big deceleration in growth like that, not good for the stock. Abercrombie is getting clobbered here, down 11.5% this morning, $85.48. That's off by more than $10. All right, let's talk a little bit about my favorite company, CoreWeave, because they were making news yesterday. IPO-bound CoreWeave to buy AI developer Weights and Biases for reported $1.4 billion. I've also seen it reported at $1.7 billion. And of course, my first question was, freaking who? Weights and Biases? Who? And where's CoreWeave getting this money? They haven't even IPO'd yet, and they're already diluting their shareholders that they don't even have yet. Well, that's what they're doing. Cloud-based AI intelligence infrastructure startup CoreWeave today announced its plans to buy the AI model development firm Weights and Biases for an undisclosed price. The company confirmed the acquisition plan just minutes after the information first reported that it was in talks to buy Weights and Biases in a deal valued at $1.7 billion. So it looks like the information, I would have got away with it if it wasn't for you meddling kids kind of thing. The information reported this story about this merger that they were in talks to do before they IPO'd. That's interesting. No mention of any of that in their IPO filing. I'll just throw that out there. And then as soon as the information runs the story, CoreWeave is like, oh, crap, I guess we better admit it. Yep, we're buying Weights and Biases. And were they planning to tell people before or after the IPO that they were going to immediately dilute their shareholders? I am wondering, because I don't think CoreWeave has the money. I mean, maybe they could be borrowing from their 14% interest credit line in order to make this transaction happen. And I guess you could always put it on the credit card and get a slightly higher rate than that if you want. But yeah, CoreWeave, they're already merging with somebody. They're a hardware company. Now they're buying a software company. It's got nothing to do with their core business, but good luck to you. Good luck, guys. I hope the IPO goes really well. And speaking of the IPO, I found this little gem hidden in the risks section of their IPO paperwork yesterday. I put this one out on Twitter. This says a substantial portion of our revenue is driven by a limited number of our customers. And look at this number here. For the years ended December 31st, 2023 and 2024, our largest customer was Microsoft. We knew that, which accounted for 35% and 62% of our revenue, respectively. Microsoft is 62% of CoreWeave's revenue in 2024. And remember, guys, according to that TD Cowen note that came out just a couple of days ago, Microsoft is canceling plans for data centers and canceling letters of intent for data centers. And that's 62% of CoreWeave's revenue. Oh my God, thank God nobody reads these things. Wow, if anybody bothered to read anything about this company, they may not like what they saw. Well, that, and maybe that's why they're buying weights and biases, because they're like isolated risk to Microsoft is so high. I don't know, but something tells me the CoreWeave IPO marks the top, or dare I say the top is already in. CoreWeave probably should have IPO'd 6 months ago. They would have got more for the company, but they're greedy and they had to keep it going just a little too long. I just want to say thank you very much to Mr. TK. He's been a melonhead for 7 months. Thank you, TK. He says, when will we get the State of the Melons address? I'm pretty sure that's what you guys just got in the opening of this show. I mean, I didn't say billions and billions and billions of dollars over and over again. But yeah, that was the State of the Melon address. Sure. Why not? Thank you very much, sir, for being a Melonhead member for 7 months. The State of the Melon is we have been in a recession since 2022. The press is finally admitting it. And now the asset prices are going to play catch up. That means stocks, houses, all kinds of stuff, possibly even gold and Bitcoin, could head lower on that news. Maybe not so much gold. There's a lot happening in the gold market. Atomic Coyote says, German 10-year yield up 23 basis points so far today. It appears my chart was a little aged. 23 points. How long is that sustainable? It's not sustainable in its current form. So no, it's already not sustainable. I'm telling you, the European Union, they are gonna Zerpenburg like you wouldn't believe, or Zerpenblagen, however you say it in Deutsch. Money printing is coming. And look, that's kind of why I said Europe and US are going in two different directions here. It really looks like through policy, if you forget the talking points and look at what policy is doing, the US is steering intentionally towards a deflationary recession, whereas Europe is doing the traditional Zerpenburg, print and spend your way out of a problem. And I know which direction I like better. Of course, politically, one is a lot easier to sell. It's always easier to sell money printing and sell lower interest rates and then blame corporate greed when the inevitable inflation shows up than it is to say job losses and lower home values and 401ks losing value is really what the country needs and is better for the economy in the long run. That doesn't make people feel any better when they're watching their net worth go down nominally. But I think the direction the U.S. is taking is the better one. Thank you very much, Atomic Coyote, for the super chat and support of the channel. And Break My Wallet Motorsports. That name gets me every time. He says, you earned that with your impeccable German. Thank you. Apparently my German, I don't know, maybe the translator, the lady who translates into sign language, she heard Printensplingesblatt. And okay, anyway. Yep, that's my German. Thank you very much. Break My Wallet Motorsports. Appreciate the super chat. And he's back again. He said, oh, no, he did it twice. Did I earn it twice, or did you fat finger a double super chat? Either way, sir, I am grateful for your fat-fingered compliments on my Deutsch. JJ Watt, thank you, sir. He says, can this incoming engineered recession cause metals to spike versus drop as they would normally in a non-engineered recession? All right, so gold is a safe haven asset. And conventional wisdom would say people buy gold during a recession. So it's possible you see some piling into gold as interest rates fall, as people position themselves defensively. That being said, eventually, hopefully, the deflation gets here. And if we do enter deflation, or at the very least disinflation, well, that's bad for asset prices across the board, which would include gold. That being said, I still own gold. I'm not in a hurry to sell any gold. I wouldn't be going out on leverage if we're heading into an asset recession. But I think gold, there's enough pent-up demand for gold, or there's enough artificial suppression of the price of gold that I wouldn't worry so much about that deflation there. So could it cause metals to spike? maybe safe haven demand would take metals up. I don't think it's going to be a huge spike, though. Gold has had a magnificent run for the last 6 months or so. It needs to sit and catch its breath for a little while. So we're probably going to hover around this 3,000 level for a little while here. I would love to be wrong about that and see us blow through it, but I think we're going to be here for a while. Thank you, JJ Watt, for the support of the channel, and thank you to Steve Canyon, just being a swell guy. Let me see. Did Steve leave a message? I don't see anything, Steve. Thank you, sir, very much, just for being a swell guy. Can't hunt through it. I don't know if there was a question. If there was, I'll get to it tomorrow, though, but I appreciate the support of the channel. All right, guys, thank you so much for your generosity. That's why I think we are heading toward an engineered recession. That's why I think we should be. That was a lot to get through. Thank you so much for supporting the channel. Thank you to my magnanimous melonheads on YouTube and Patreon. You guys rock. Appreciate that very much. Links down below, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Don't forget that like button and that subscribe button on the way out. And until next time, live small and dream big.